Is this the beginning of something big? Bitcoin finally hit new all-time highs, just as gold makes new all-time highs. All the while, technology just went on one of its ugliest days since late October. So what is the sentiment right now? Is it risk on, or is it time to get defensive? Today, we're going to discuss that and the fundamental driver of equity returns in the last 2 years. The answer isn't AI or buybacks, and it actually might surprise you. So when we have a red day such as we had today and sentiment dives, sometimes it's good to step back and have a look at the big picture. So today, we're stepping back and answering the question, is this the end of the road for the bulls? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. Brutal day in the market, especially here in technology. Look at software infrastructure, application software, rough day for those names. Semiconductors took it hard except Nvidia. And this is how you know Nvidia is the market leader right now. It outperforms to the upside and the downside. But there were pockets of green, guys. Regional banks were very green. Financials were pretty much flat on the day. There were winners, there were losers. Energy was also very green. And then pockets in defensive sectors. Look at discount stores. Look at this area right here in healthcare as well as utilities. However, to me, this screams liquidation. Why? We saw a deep red sell-off in the big names, Tesla, some of these technology stocks, right? But that money didn't rotate into defensive names. I think consumer defensives were really lit up because of Target's earnings more than it was a defensive rotation. If this was a defensive rotation, we would have seen broader participation in healthcare as well as utilities. So for now, to me, this is just a sell-off, a liquidation, people just pulling money out from their winners. Things are getting a bit frothy, especially with the crypto names. And I think people are just going to hold cash, look at some good levels to pull back to, and then buy the dip right there. At least this is what it stands for now. If we start seeing this go really green, utilities especially, and then healthcare names pick up, okay, that's when we can really start to look at, okay, maybe the market's getting defensive. But as I see it right now, looking at the data, the market isn't getting defensive. This is just a liquidation, and we should look at this as a potential dip buying opportunity. Now let's find some areas of opportunity on the charts. Now guys, this is the S&P 500, but before we get into this, let's have a look at the indices. Now the S&P 500 and the NASDAQ down 1%, the NASDAQ 1.8%, brutal day led by technology, but we actually saw outperformance in the broader market. Look at the RSP, mid caps, small caps, they were all down about 0.3, 0.4, 0.5% for the day. IWM, less small caps and more small caps, micro caps, down nearly 1%, up a little bit in after hours. We saw volatility pick up, but for the most part, pretty brutal day across the board. We saw bonds had a bit of green, so rates did fall on the day, especially 20-year treasuries. Look at TLT, pretty big day. Bitcoin down 8%. Now on my charts, this is CME futures. Because it's regulated, I look at this more than the actual price of Bitcoin. We did go ahead and make a new all-time high in Bitcoin, a wick high, however, not a closing high there in Bitcoin. But that being said, let's have a look at the S&P 500 chart. Now, this is the weekly chart, guys, and you can see at the end of the day, we are still in a long-term uptrend, higher highs and higher lows, as you can see right here, all the way along the way up, as well as a new all-time high just yesterday. Big picture, S&P 500 still in an uptrend. Looking at the daily chart, candle structure and location, we can see here that today's candle, this right here, a red-bodied candle. We closed in the bottom third, win to the bears, but there was a big wick right here, win to the bulls. All in all, this is a bullish candle. We did gap down, but we did find support at some very key levels. All week in the weekend video and yesterday, I told you guys that there are two key levels we want to look at as potential buy opportunities. The first is this right here, the 5,100 area. The second is actually the bottom of this range right here, the 5,050 area. And what do we know? Buyers came in at this exact point right here. Does that mean we see follow through tomorrow? Potentially. I mean, let's pull up the 5-minute chart. We could see that we pretty much had a vicious sell all the way down to the lows of the day, and then we only got this reaction. Put buyers came in, took us all the way down. So if retail is long puts, dealers are short puts. That means dealers hedge by selling stock. The unwind is a buyback, and that's why we get a bit of this rally towards the end here. All in all, win to the bears nonetheless. But if we go back to the daily chart, what we can actually see is that we did find support at this level. Now, two things need to happen tomorrow. Number one, bulls, if they want to see follow through, need to go ahead and get price a close above the 1,100 area. From there, we can then pull back, use it as support, continue the rally, go hit all-time highs. What the bears need to do tomorrow as well, however, bears need to push all the way to this 50-50 area, and we really need to get a close below for us to then use as support. If this scenario does happen, we're actually going to be looking at this level right here as key to close below. We close below this level, we can then take sell side all the way to the 49.62 area. Now, we're not going to be talking about anything below here just because we're not there yet. And we are a while from there. It is about 3-4% to get to this level right here. Nonetheless, this is a fantastic dip buying opportunity at this point. And in fact, even here is, but we just have to see what happens tomorrow. Now we are moving into the backloaded, macro heavy driven part of the week. I'm talking about non-farms. I'm talking about Jerome Powell's testimony at Capitol Hill. So there's going to be a lot of volatility in the market like there already is. Now on a weekly chart, guys, let's actually just remove, well, we'll keep them on. On a weekly chart, like I said, we are well within an uptrend, and the only time the weekly trend is truly jeopardized is if we go ahead and break below this level right here, 47.70. Let's actually change the color of this to red. Now the reason why that's important is because it's where the previous all-time high was here in 2021. And on a weekly chart, until we actually go ahead and break that, all of this selling we see right now is still a dip buying opportunity. And how far are we actually away from this area? On the sell side, from today's close to that level, we're about 6% away. And that's quite a sell-off, especially from peak to trough. We're looking at peak to trough, you're looking at 7.37%. That's a pretty big sell-off, and especially with where earnings are, where the economy is at the moment, which is good. That is a very favorable opportunity. That being said, this week, where should we be looking at? Firstly, right here, 50-50, 50-100 to the upside, 50-50 to the downside. If we do break below here, we could look at 49.62 until we actually get very close to these levels right here. Let's not even think about lower levels at 47.70. This is where we are right now, and constructively bullish when you look at it. These are the exact levels I said we would sell off to if we did get a sell-off, and here we are right now. Now looking at the NASDAQ, this does look a little bit weaker. The gap down is a little bit bigger. However, very similar situation to the S&P 500. We had this key level where we wanted to see buying, and if we do sell further, we can look at these key levels right here. Looking at the RSP, significantly stronger. Really what the bears really wanted to do today was probably wick below this level. They couldn't, and here we are. A red bodied candle nonetheless. Bears are the leaders, but look at the length of the wick at the top and the bottom. Looking at mid caps, a green bodied candle. Look at the wicks, very similar situation. And this is the level we were watching on the weekly basis to pull back to. And we still have a while to get there. We could definitely get there tomorrow, but mid caps looking the strongest out of all of these indices, and then looking at small caps, and look, the thing with small caps is this is not looking good right now, especially with this situation right here, a lower high, and some of these levels in very close contact. We could pull back here, bounce and move higher, but if we do break below, it opens up some of these levels, and we don't really want to see that in small caps for the most part. But guys, RSP, mid caps looking like the best sectors to be in right now. Otherwise, everything is playing out as it should on a technical basis in the S&P 500 and the NASDAQ. We could see some trouble, but we'll cross that bridge when we get there. Now, looking at sectors, not much more value to add here, guys. The worst performing sectors were software, technology, semiconductors. The two big ones, GDX, XLE, KRE, these two were in my top performing sectors for the month. I think GDX is up 6% since that post, so doing really, really well. But we could see, guys, look at the defensive sectors, staples, utilities, down on the day. Again, if this was a defensive rotation, we want to see these really positive, like 1% plus, and then healthcare, a brutal day here for healthcare. So it's what we're looking at is a liquidation more than anything else. Now guys, big picture, 5% pullbacks in the S&P 500 occur 3 times per year, even more, 3.4 times per year, okay? And on pretty brutal years, we can get upward of 8, 9, 10 of them. And we could also see that volatility is expected to increase in July, November of election years. So we should see further volatility come into the market up until this October, November area. Completely normal, well within market history to do so. You shouldn't be looking at this and be worried. You should be looking at a 5% pullback as an opportunity to buy, especially with where earnings are at and where their economy is currently currently positioned. Now, typically, the S&P 500 continues to rally after a strong start to the year. You could see here that normally when we do get a strong start to the year, we normally actually keep rallying relative to history. And this red line is the average right here. So momentum brings momentum. And because a positive January and February should beget even more momentum throughout the rest of the year. And hopefully we do get a decent pullback, a dip buying opportunity. Now let's talk earnings, guys. So we're going to look at Target earnings today and CrowdStrike. Both produced really good earnings. Let's actually look at Target first. They were up 12% today. They beat EPS expectations of $2.40 at $2.98. Total revenue did miss, but the guidance was a big thing. Management alluded at the fact that they're going to do 300 stores, open 300 stores by 2030. They were up 12% on the day. I think at one point up 16% in aggregate. Great earnings here from Target, completely outperformed the market, as well as CrowdStrike. CrowdStrike beat sales, beat EPS estimates, and they gave their guidance. Now it says 2025 year. It should be 2024. I just made a mistake. Now their guidance was EPS of 89 to 90 cents. The market was expecting 0.82. And then look at their revenue guide. They beat on the upside. Their full year guide, they actually beat on their full year guide, and then they beat on their revenue guide as well. And this stock was up like 26% after hours. So the market really liked their earnings, and this should provide a very good tailwind for cybersecurity stocks and maybe software stocks as well tomorrow. Now guys, I got some more seasonal stats for you guys. 10-month price returns after the S&P 500 is up January and February. And these are more sector specific. Now these are actually kind of crazy when you look at it. Now do take it with a grain of salt. Some of these data points is only since 2017, since 1995. Nonetheless, stats we can look at. Now the best performing sector or best performing index, NASDAQ 100, 20.7% return. S&P 500, 12.9%. Growth is up there as well. Then we also see value double-digit returns, mid-caps, small caps too. So a positive January and February and up S&P 500 in January and February is a very bullish occurrence across all sectors. Looking at sector specific, healthcare, infotech, discretionary, financials, comm services, those are the best performing sectors, but it's not to say others don't perform. I mean, look at staples, 12% return. You don't brush off 12% return in 10 months. Look at industrials as well. Now the worst performing subsectors, we're looking at application software, steel, oil and gas, and gold. And then the best sub-industries, and these are all 20% plus. We're looking at consumer finance, casino gaming, apparel, software systems, home building, biotech, retail home improvement. So just some sectors there that you guys can look at, maybe find some value and get some outsized returns or alpha this year. Other places you can look to put your capital to work can be in place such as global equities. Now you could actually have a look at stuff that are less crowded. Normally it does pay to be a contrarian in the market. Now you can see here that this is more crowded and this is less crowded, and a lot of people are sleeping on stuff like emerging market large caps. Gold miners, one of my picks for the month of March, by the way. Look at stuff like oil and gas, very neglected right now. China large cap. These are areas that not many investors are looking at. Deep value, especially oil, China, gold miners as well. A little bit pricey on some metrics, other metrics cheap. But then you look at stuff like US large cap growth, small cap growth, large caps in general, emerging market small cap, China small cap. These are very crowded trades that everybody's on right now, and there's less value to be had here. Now looking at the fundamental picture, something we're seeing investors pay more attention to is margins. Margins have taken on an elevated importance for valuations. In 2019, 2020, 2021, it was growth at any cost. Investors are less focused on sales growth, top line growth in 2024, and more focused on net margins. So essentially what investors are saying is, you had 3 years to grow your revenues, and a lot of companies did do that. It was growth at any cost, and sales growth was amazing. Now investors want to see this revenue turned into profits for shareholders to provide shareholder value in the form of dividends, share buybacks, acquisitions, shoring up the balance sheet. And this is why the market goes through these cycles where sales growth is more important and then net margins is more important. So when evaluating stocks, when looking at investments to buy, particularly for a time frame of 6 to 12 months, look at net margin growth, look at net margin improvement. In that way, you'll get outsized returns in the next 6 to 12 months. But what you really should be looking for is a minimum of 0.1% margin growth at the absolute minimum, simply because Goldman Sachs expect profit margins in the broad market to increase modestly this year, and that number is 0.1%, driven by lower input costs, lower labor costs, and tech strength, so like productivity, AI, that sort of thing. Now, this is the absolute minimum you need to look for, 0.1%, and when evaluating evaluating companies to get outsized returns, look for even greater than 0.1% for the full year. Do take into consideration that rate cuts are actually being pushed further out in 2024, and this could tangibly affect this. So you do want to factor in this right here and build a bit of a margin of safety when looking at investments and evaluating where you want to put your money. That being said, the macro theme this year and probably in 2025 will be margins, will be bottom line, and shareholder value creation. Now, at the same time, we shouldn't really be worried about the top line. I think the top line for companies will be pretty healthy simply because Goldman Sachs expect GDP to grow at about 2.75, 2.8% in 2024. The Bloomberg consensus is about 2.1%, and Atlanta GDP now is sitting at 2.1% as well, which is in the middle of the range of the top 10 forecasts here for GDP now. So top line should come in at a minimum of 2 to 3% for companies you're looking at buying, and look for margin expansion in excess of 0.1% for the full year. If you guys evaluate your investments on that, you're going to do very well this year because this is the major theme we're seeing in the market right now. Now let's talk seasonality. This is very, very interesting. This is BOFA's sell side indicator. Now this sell side indicator is a very good indicator for future returns. And you can see here that the SSI ticked up 33 basis points to 54.37% in February, moving slightly above to its 15-year average. This level implies price returns of 13% over the next 12 months. Historically, when this indicator has been here or lower, 12-month forward returns were positive 94% of the time at 13%. This is where we are right now. So we're in this neutral zone. Oftentimes when we do move from this extreme bearishness bullish for stock zone, this green zone right here, when we do move from that area into this area, it is very supportive for equities. And where we are right now, we can actually see outsized double-digit returns for the rest of 2024 and in the next 12 months. Now looking at S&P 500 seasonality for the month of March 1950 to 2023, we could see a very healthy uptrend throughout March, but we are approaching the 5th, 6th, and 7th day in the month here. We can actually see that we normally do get a bit of a pullback. So if we do see some selling in the tape, completely normal, and we normally actually put in the lowest low of the month. We put in a low right here and we actually go ahead and break it, put in the lowest low, and this should just be viewed as a dip buying opportunity for us to go long for the rest of March. So if we do see a bit of selling, completely normal. However, we should stay above the March open. If we do actually go ahead and break this, that could signal a bit of trouble. But as it stands, if we do get a bit of selling in the tape over the next couple of days, even into early next week, completely normal, nothing surprising here. Backing that up, we actually see here CTAs, global CTAs, as well as S&P 500 CTAs, which are just like trend following algorithms, just algos pretty much, have a lot of downside convexity versus upside convexity, as you can see right there. So they are net sellers over the next month, both in global flows as well as S&P 500 flows. However, something we're seeing in the gamma tape is a little bit different. We are seeing negative gamma creep up into the tape, but what we did see is the 5200 call gamma resistance strike move up. It moved up from 5100 to 5200, and that's very, very bullish, and we are still in positive gamma. Any selling we do see should just be looked as a dip buying opportunity for us to go ahead and hit this 200 area, because dealers do want the market at 5200 before OPEX just to go ahead and hedge their books so they are delta neutral. That being said, the gamma flip zone right now is at 5000, and if we do get to this level and break below, we could see some serious downside flows here below the 5000 level as we enter negative gamma. That being said, all dip buying opportunities, if they do occur over the next 3 to 4 days, should be just viewed as dip buying opportunities and nothing more until we get more confirmation in the tape. Now guys, these are a couple of charts that we look at every single week. It's essentially just sector performance against the S&P 500. If this chart is moving up, it means the index is doing better. If this chart is moving down, it means the S&P 500 is outperforming that index. This right here is XLK technology, and in the last 12 to 18 months, you could see that technology has handily outperformed the SPY. On AI hype, we could see a discretionary. It has marginally outperformed the SPY. There was peak outperformance for most of 2023, but after Tesla has underperformed for the most part, we've seen the SPY perform significantly better against the discretionary sector. Overall, consumer discretionary has outperformed the SPY on a start to close basis. Looking at comm services, handily outperformed the SPY, and the majority of this index is Google, Meta, Netflix, two components of the Magnificent Magnificent Seven, who have really significantly outperformed the S&P 500 in the last 18 months. Looking at semiconductors, what can I say? Complete outperformance and even accelerated outperformance right here. And there was only real one point on this chart when the SPY did better. Other than that, they traded pretty much the same, if not the semiconductors were doing significantly better than the S&P 500. Looking at industrials, we've sort of formed like a base right around here for industrials, and you can see that if we actually draw a straight line back since about April 2023, the SPY and industrials have pretty much gone back and forth. Normally industrials and the S&P 500 track each other pretty closely, but on a close to open basis, the S&P 500 has done better. But if you actually look at it from normalized performance since April, it's about the same. Sometimes SPY outperforms, sometimes industrials outperform. Looking at energy, we could see that in 2022 we had peak outperformance in energy, and as inflation has been curbed or slowly decelerating, we have seen energy completely underperform the SPY for the most part. But it does look like we sort of are forming a bottom here, and I am bullish on energy. That being said, we do want to see some of these levels being taken out before we do actually get outperformance in energy, and we do want to see improvement in the oil demand outlook. Until that happens, we'll continue to see this chart move sideways. If anything, the S&P 500 will outperform. Looking at utilities, and utilities have just been a bad trade against the S&P 500, just down and out, and that's because in the last 18 months it's been risk on. Utilities is really a risk off signal. Looking at healthcare, very similar situation, but we are starting to form a base here in healthcare, and earnings are expected to grow, so I would expect healthcare to outperform in the next 12 months. That being said, for the most part, the S&P 500 has outperformed healthcare in the last 12 months. Looking at staples, similar to utilities, it's a risk off signal and it's been risk on in the last 12 months. Materials, we've seen a stark improvement right here in the materials sector. However, the S&P 500 has been a much better trade for the better part of a year, and you might actually find some value in the materials sector. So this might be one to look at, guys, if you want to find cheap stocks at a reasonable price and at a good yield. Just do take into consideration that this is a commodity sensitive index. Now looking at real estate, last one, and the S&P 500 has outperformed real estate simply because rates have increased in the last 18 to 12 months significantly, and they haven't decreased. The Fed funds rate is still exactly the same way it was in July last year when we had our last rate cut. Even though financial conditions have eased, real estate affordability is still at some of the lowest it's ever been in the last 20 years, and that even applies for commercial as well. A lot of headwinds coming in the way of real estate, both for residential, commercial, industrial, and all of real estate as a whole, especially with higher rates. Now looking at the final chart, financials, complete outperformance here by the SPY, but again, similar to industrials, we formed this base, and for pretty much the last 10 to 12 months, this chart is moving flat. It means that the returns on the S&P 500 and the XLF are roughly the same, and so they performed exactly the same. We have seen the SPY outperform, financials outperform in periods like here. However, for the most part, they're trading very, very similarly after this massive drop here in early 2023, and this situation was the SVB bank crisis, and we'll see if something very similar happens in financials if we do get like a CRE scare, maybe a commercial scare, a regional scare in banks. Even though it might affect regional banks and not so much the big boys, the financial sector as a whole is affected. Now looking at my recommended sector positioning, you want to be overweight right now. Tech, healthcare, financials, energy, comm services. This is from the start of the quarter, the 2nd of January. It updates every quarter, so this was from 2 months back. That being said, we can still look at the data. Neutral, industrials, discretionary, and then underweight pretty much the defensive sectors, staples, utilities, and then materials, real estate, commodity sensitive, rate sensitive sectors right here. All in all, you can see the S&P 500 has returned 8.39% year to date and has outperformed every single sector except comm services and technology. Data tomorrow, we have JOLTS and ADP employment. This is actually going to give us a bit of a heads up as to what the non-farms are going to look like. So ADP employment is sort of like payrolls that are 30 to 50 employees, and then non-farms is just everything else. But yeah, ADP employment is going to be a big one, as well as the JOLTS job openings. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell. Guys, please like this video and leave a comment for the algorithm. Cheers.